Q2, that's the period Tesla just reported a significant earnings miss for, yet still managed to beat revenue expectations. But here's the real kicker. Their cash burn rate was actually less than analysts feared, signaling underlying financial discipline. For every savvy entrepreneur eyeing the future of mobility and the EV market, this isn't a red flag. It's a massive green light, highlighting strategic shifts that create fresh, untapped opportunities right now. Tesla's Q2 revenue exceeded forecasts at $24.578 billion, a 43% year-over-year increase, thanks in part to strong demand for its Model 3 and Model Y vehicles. Despite this, net income fell short of estimates, largely due to an increase in operating expenses related to its expanded manufacturing capacity and the production of the Cybertruck. Think about it. A company like Tesla, facing an earnings miss, usually sends shivers down investor spines. Yet the market's reaction isn't a full-blown panic. It's a recalibration of expectations. Why? Because the revenue beat proves market demand for EVs is still robust, and crucially, managing cash burn amidst growth shows operational efficiency. This isn't just about Tesla's balance sheet. It's a clear signal about the broader electric vehicle ecosystem's resilience and evolving landscape. For side hustlers and small businesses, this means the foundation for supporting services and niche products around EVs is stronger than perceived, despite the headlines. Here's what most investors missed in the knee-jerk reactions. The less-than-expected cash burn isn't just a number. It's operational discipline in action. It tells us Tesla is streamlining, optimizing, and finding efficiencies even as they scale, perhaps learning from early market over-expenditure. This is evidence that the EV industry, while maturing, is also getting smarter about unit economics. It means businesses building around the core EV manufacturers, think charging infrastructure providers, aftermarket accessory creators, or software solutions for fleet management, are entering a more stable, predictable environment. Whoever spotted this trend early, like entrepreneurs launching Shopify stores for EV accessories or developing SaaS solutions for battery optimization, is already profiting from this underlying strength. Here's the surprising truth nobody talks about. An earnings miss for a giant like Tesla often clears the path for agile, niche players. While the big fish are optimizing operations, the real opportunity is in the gaps they leave or create. Think about it. A maturing EV market needs more than just cars. It needs innovative charging solutions, specialized repair services, and community platforms. Your concrete next step today? Research the burgeoning EV aftermarket. Identify one specific accessory or software utility that solves a common pain point for EV owners. Anything from smart charging apps to custom interior organizers. Then, leverage a platform like Shopify to build a direct-to-consumer brand or explore a SaaS model. This is how you turn a corporate headline into your next revenue stream. Bloomberg analysts are already pinpointing a critical shift for businesses operating in developing markets. At the Vietnam Private Economic Forum 2026, entrepreneurs from Ninh Binh proposed examining administrative tax violation mechanisms. This isn't just local news. It signals a broader trend where governments are actively seeking to create more favorable conditions for private sector growth. Savvy investors watch these signals closely, understanding that regulatory clarity often precedes a surge in foreign investment and domestic business expansion. It's about building a more transparent landscape, crucial for attracting capital. For a global audience, this highlights the subtle power shifts occurring in emerging economies. Where regulation becomes more predictable, growth often follows, creating new revenue streams for everyone, from SaaS providers to e-commerce ventures. Southeast Asian markets are particularly sensitive to shifts in policy, and this dialogue in Vietnam sends ripples. Major players, from logistics firms eyeing supply chain diversification to tech companies seeking new user bases, respond by re-evaluating their market entry or expansion strategies. Countries like Indonesia and the Philippines, which often compete for similar investment, will be watching closely to see if Vietnam's proposed study leads to concrete policy adjustments. A more consistent tax framework means less risk for foreign capital, encouraging broader economic participation. This kind of legislative discussion, even at a local level, can influence regional trade agreements and cross-border partnerships, directly impacting where global brands like Amazon FBA sellers choose to set up shop. Consider the parallels to Ireland in the early 2000s, which radically transformed its economy by clarifying corporate tax structures. That move attracted giants like Google and Apple, cementing its status as a tech hub. Similar discussions about tax consistency in post-Soviet states decades ago also spurred significant Western investment. The key takeaway from these historical cases, documented by the WSJ, is that when a government openly addresses administrative hurdles, it's a strong indicator of intent to foster economic activity. These moments create fertile ground for new businesses and side hustles, as reduced uncertainty translates directly to lower operational friction and higher potential for profit margins. History shows us these periods precede significant wealth creation. Who truly gains from discussions around administrative tax consistency? Beyond the obvious local businesses in Vietnam, the biggest beneficiaries are often the service providers who help companies navigate these changes. Think about it. Tax advisory firms, compliance software developers, and legal consultants specializing in international commerce. Companies offering outsourced accounting or cross-border payment solutions also see a boom. On the flip side, businesses reliant on opaque or informal practices face pressure to adapt or exit. For individual freelancers, understanding these shifts means new demand for skills in international tax compliance, particularly for those serving clients expanding into or out of these evolving markets. This isn't theoretical. This is real-world demand.